Hello, everyone. This is Will, aka Dr. Financial Literacy. Hope you're doing well. Sorry about the lighting. I'm trying to get it right. But I just wanted to update you on how I was successful in getting the home equity line of credit. And that was one of the things that started me down the road of doing the channel and doing the videos to educate more individuals on the process. So I signed for the HELOC, aka the loan, aka HELOC, on the 9th for 50,500, 150 pages. I signed maybe 50 times, and initial maybe 15. So I just wanted to give a follow up and start shooting some different videos on my experiences as I share them with you and share them with my clients, and will welcome you aboard to become a client to work down reducing your credit card debt or your mortgage debt, student loan debt, and other debt in general. So I'm still going down the path of velocity banking. Velocity banking to me is simply taking a line of credit and using it to reduce debt. This may be an existing line of credit, such as a credit card that I had that I started, or securing another line of revolving credit to reduce your debt in general. So first and foremost, this HELOC that I have, although they call it a line of credit, it is first and foremost a loan. That means I went to the bank and I borrowed money. It's a loan, plain and simple. It is a loan. Secondly, refinance. I am refinancing some of my debt in general, and that included a mortgage, credit cards, and loans, and maybe some smaller bills. So now I just want to simply make a comparison between what I had and the new loan in general. Let me move this over just a little bit. Oh, okay, so I started with a mortgage, and it was a 30-year mortgage. I had 15 years remaining on the mortgage. It was at 6%. I started it at 41,200. I mean 41,700. I think that was in 2009. I may have to go back. Cost starting in 2009. Again, as I mentioned, this is a loan in general. So I just really wanted to look at the two. So I'm going from a mortgage to a second mortgage, which is sometimes called a HELOC or HELOan. And what I have is a HELOC, a home equity line of credit, which is based on the actual balance that I had on the loan, which was like 35,000, and the appraised value, which was like 211,000, and they gave me some money based on that equity and that range. My original was started off as 30 years. I had 15 remaining, but once I started doing velocity banking and looking at the concepts, it helped me to reduce credit. It helped me to reduce debt. I went to go get a larger loan to help further reduce some of my other debt. As I mentioned, I had a total of $350,000 in debt. So this $50,000 loan will help me further reduce it. So now, as of today, it's going to be a 30-year loan in general, and it's broken down into three phases. I'll go further into the next detail, but in general, it's 30 years. The first 3 years I will be able to pull money down, use it, go in and out of it. According to the contract, the next 7 years will be a holding period where I may not be able to pull money out of it. And the last period will be the principal and interest that needs to be paid. But for the first 3 years, at a minimum, I'm just obligated to pay the interest, but I will be paying the interest and some on the principal. The rate on the loan is 10.25%. Now, it's a variable loan also. So that means it has a high and a low as it was mandated in general. So the lowest percent that this loan can go is 4%, and I would have to pay $168 a month. The highest that this loan can go is 18%, and I would have to pay $700 a month. Now, what I've done is I've already factored that in. Now, before I consolidated and went into debt, before I consolidated and went into it, the debt that they consolidated was running me about $933 a month. With this new payment at 10.25 is $424 a month. I want to make sure that my calculations are correct. Okay, so from what I was paying, $933, and now I'm paying $424. That's a difference of, I'm sorry, $923. Okay, I was paying $923 before they consolidated the debt to give me the loan. Now I'm paying $424 interest only for the first 3 years, $499 difference. Now I'm gonna be paying more than the $424 because I want to pay down this principal of $5,500, but I'm paying less in general. The category, they're both loans, but sometimes this is referred to as a HELOC, home equity line of credit. The first loan that I had was fixed and closed. I couldn't go in it. I couldn't go out of it. I couldn't borrow money against it. Well, now I can. So this new loan is starting out at $50,500. That is my new mortgage, new loan, or even if you want to call it a line of credit. And each one of these payments of $424 will go to pay down this principal. But if I'm only paying interest only for the first 3 years, this can fundamentally never really change because I'm only paying the interest. So the principal can stay the same until that seventh year or the 4th year when I start really paying on the principal, but I'm gonna pay more. At the end, I was able to consolidate about $46,475 worth of debt. That included one of 3 of my mortgages at $35,700. Closing cost to do this loan was $2,300, and I think that left me with $14,000 in other debt. $35,700 plus $2,300 in closing costs. $35,700 plus 23,550. That left me with about $12,000 in other loans and bills that was consolidated under this new loan. All right, so that's what I just wanted to stop in and talk about. I'm going to continue to use velocity banking. It did well in helping me to reduce my credit. It's working well with me working with clients to reduce their credit using the concept of velocity banking in terms of credit card debt. I'm starting with a $50,000 loan that's variable, it's open, just like a credit card, so I can make payments on it and take money out of it. As I showed before in previous videos, I will start making my mortgages out of the payment, my escrows out of the payment, my bills, travel, dining out. Fundamentally, this new loan that's set up kind of like a checking account will be my checking account, and I will be doing everything that I can through it so that I can lower the average daily balance every day and try to get this thing paid off in about at least 3 years before the principal and before the hold period where I can't make any draws. Now this is just for the company that I'm with. Other companies may have different periods, but according to the contract that I signed and contract that I have with my lender that lent me the $50,000. Again, 3 periods. The first period interest only. 4 through 7 will be a holding period where I can't pull down any money from it, and then the last 20 years will be a principal and interest period in which I got to pay down whatever I hadn't got to there. But overall, yeah, I'm definitely doing better. Velocity banking, I like it. I've run some tests against it. It has helped me reduce my debt, and only in a sense of I could have continued to do what I do, which I was paying maybe $100 extra on each one of my mortgages extra. So I was ahead maybe by a couple of years. Velocity banking, my expectation based on other YouTubers and what said it can be paid off in 3 to 7 years. So I'm now putting that to the test. Can I pay off a $50,000 mortgage in 3 to 7 years, if not sooner? So I appreciate you helping me along the journey. As I talk to clients, bring them on, and we see how they're doing with velocity banking. Really wanted to share this with the community, give you a little bit more information and knowledge. Please hit the like button, share it with others that have debt to try to reduce it. I think really velocity banking can be a game changer in your household and even in your community in getting some of the debt and helping out others. Again, thank you very much for stopping by. Thank you very much for being a part of this blessed opportunity that I've had to educate you and the public on velocity banking and reducing debt. Again, Dr. Financial Literacy. I am a political economist. I am not a certified planner. I am not a CPA. I am not an attorney. I'm just a political economist, just running experiments, doing this, and showing you and my clients the potential. All right. Thank you very much. Have a great day.